well, let's get some flow picture now. We have Cameron Brandt, Director of Research at EPFR Global, joining in. Cameron, good morning. Great to have you with us here on CNBC-TV18. We were just discussing, I'm not sure if you're familiar with these new rules of essentially what our market regulator SEBI wants is, it wants foreign investors to disclose their end beneficial owner. A lot of money in India comes through instruments which are called participatory notes, P notes. And, this is the route which perhaps gets impacted the most. Now, there are threshold, there are sort of 2 or 3 factors which have been defined by the SEBI above which you have to disclose. I'm not sure if you've heard of it. If you have, any thoughts you may have?
I've certainly heard of it. I've been sort of doing this long enough to, regard this almost as sort of, that there are periodically initiatives within Indian financial regulation that sort of worry foreign investors. But as I understand it, there's several months before it's implemented. And honestly, I think if the effect looks too painful, historically, there's some moderation. At least at the moment, it really hasn't impacted, the flows to the India-mandated mutual funds. They aren't taking in money at quite the same torrid pace they were, especially in the second half of last year. But that moderation had already started before Christmas. And that said, we're still seeing very consistent inflows into the dedicated India funds. We're certainly expecting a fairly bumpy first quarter for really most asset classes. There's a major slate, as big a slate of important elections as certainly I've seen in many years. There is the sort of back and forth on when and to what degree the European Central Bank and the Fed will start cutting interest rates, and obviously the geopolitical tensions in the Middle East. So even though I think from where you sit, it looks very, concerning, especially when linked to some of the FII outflows you've seen recently, I would be disinclined to put too much weight on it just now.
The point is, if you are inclined enough to stay in a market, you find a way around it, Cameron, right? We've seen that in the past. I mean, these things, as you said, have come and gone. But maybe in the very near term, we just need to watch. I mean, on a day-on-day basis, sure, it can influence flows, etc. But take your point, Cameron. Sonia.
Cameron, hi. Good morning. You started by also saying that, there's a lot of money being put into the Indian markets, and that's something that can continue. We have a big event upon us, which is the union budget as well. It is a vote on account, but there will be a full-blown budget in July. From an investor standpoint, do you have any expectations? And do you think the money will continue to flow in irrespective of what comes through?
I think, the people certainly pay attention to the budget, and, if there's a real horror lurking there, you'll see a reaction. But what we're also seeing, certainly over the last few months, is sort of a very granular approach to investing, certainly through mutual funds, country-specific rather than regional. In some cases, really sort of down to, baskets of a few preferred stocks. For India, I think that's to the good. Within the emerging markets universe, really, you remain sort of one of the better stories. The market run up last year was sort of crying, I think, for a correction, which you're starting to see. But, the combination of demographics, decent growth, stable politics is very attractive to investors who want some emerging market exposure and are looking over a landscape where you can find pretty serious drawbacks and issues wherever you look.
Hi, Cameron. Good morning. Cameron, I had a broader question, though. The Fed has suddenly sounded a little bit skittish, and, maybe in the last 7-8 days or so, from expecting cuts, and expecting at least a quarter percent point cut from March, that probability has fallen. So have you seen outflows from emerging markets itself? That could explain some part of the selling that we're seeing in the Indian markets.
What's been interesting, certainly in the first 3 weeks of the year from a fund flow perspective, is how similar it is to the patterns are to what we were seeing sort of in the month leading up to Christmas. Emerging markets flows in aggregate are positive, but they rely very heavily on investor interest in a number of major emerging Asian markets, of which India is in the top 2. And I don't think, though the sort of market reaction to the dovish tone of the Fed meeting in December was very strong, that reaction was pretty short-lived within the mutual fund space. People started kicking the tires quite quickly and scaling back their expectations. So, I think that we will certainly see some rate cuts in the first half of the year, but it might not be in March. There's enough variables. American consumers still have quite a bit of cash available, piled up in liquidity funds, which took in $1.2 trillion last year. So, they can swim against the interest rate tide a bit longer if they choose. So I never thought it was a given that the Fed would cut that early, and I think quite a few people have a similar view.
All right, Cameron, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC TV 18. Let's slip in